Welcome to Real Estate Investing for Professional Men and Women, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, everyone, and welcome to Investing in Real Estate for Professional Men and Women. Glad to have you back. Good to see you and have you be part of this. My name is Gary Wilson. In today's podcast, we're going to talk about how do you acquire investment real estate by leveraging investments. Leveraging your retirement investments, okay? You may have a 401k. You may have a self-directed IRA. If you don't, I'll explain how you can get one. And we'll also venture off just slightly, talking about how you can leverage a whole life policy. Those are the three things we're going to cover today, okay? Now, if you think about it, these are techniques whereby you can borrow money to acquire an income-producing asset. In other words, a rental property, generating cash flow for you, passive cash flow, so that you can start to see the end of the rainbow. All right. I know if you've got a practice or you have your own business, what that's like, because I do. Okay. I used to be a corporate employee, corporate vice president for years, retired when I was 40 years old. And had enough, decided I'm going to do it on my own. And thank goodness I did, because life is a lot more fun. You have a lot more control. As long as you have the slightest bit of discipline, you can do quite well, guys, especially when you involve real estate. Doesn't matter what you're doing. You could be an engineer, chiropractor, dentist, teacher, fireman, policeman, pilot, military. The bottom line is either you're working for someone else and you have some type of retirement vehicle, or you have your own practice, your own business, and you have a retirement vehicle there, okay? But the point is this type of borrowing that we're describing today, you're actually borrowing against yourself, okay? So let's just dive into it. By the way, real quick before we do, these are not to be construed with a lot of the smoke and mirrors techniques that you see on late night TV and a lot of gurus are teaching. I'm not knocking them because they actually do work. I will just tell you, they're not for us, generally speaking. People who are professionally minded, you're professionals in your field, we think differently, okay? We understand the principle of having skin in the game. We also understand that, investing properly when you do have skin in the game usually generates a far better empire down the road. I can tell you, you can see this graphically by studying other investors and other statistics. All the people that were always preaching all that no money down stuff, unfortunately, many of them declared bankruptcy in the Great Recession. Even the grandfather of all, Carlton Sheets, had to declare bankruptcy in the Great Recession as an elderly gentleman after all those decades of teaching no money down, owner financing stuff. When the what hit the fan, it bit him right in the butt. As well as some other well-known figures. I don't want to go into a lot of details, but they admitted that they had to declare bankruptcy. It's public information. Why they're not going to keep it a secret? Because they're public figures. You're going to find out anyways. You might as well be truthful about it. Thankfully for me, I didn't do all that stuff in a Great Recession. I didn't have to declare bankruptcy or have foreclosures, do any of that kind of stuff. Didn't have to. I had great equity and great cash flow. I was able to weather the storm, thank goodness, because I bought using the techniques I'm going to teach you. So in any case, welcome aboard. Welcome to the community. I'll talk more about the community here at the end of the podcast because I want you to be part of it, and you can certainly join. All the rest of us professionals and in our own fields and business owners, okay? So first things first, let's talk about you. Let's say we'll do the simple one first. Let's say you do have a 401k. Maybe you're working for a larger corporation and you have a 401k. Or maybe you have your own business or your own practice and you have a 401k there too for you and your employees. Well, the good news is you can borrow against that 401k. And most companies, if they follow the federal guidelines on this, you can, as an employee, can typically borrow up to 50% of the cash value of your 401k. Okay, so you're actually borrowing against yourself, which is really neat because what that means is when you pay back with some interest. They tell you what that interest is. It's usually nominal, something like based on prevailing rates, 4% today, for example. And so when you pay yourself back, you're paying yourself back with interest. You're actually making money on the money that you borrowed. How about that? As well as the investment you're going to be making with the borrowed money. Kind of interesting how that works. And I tell you what, I'll even sweeten the pot for you here. Check this out. Back in the 80s, you could actually borrow against your own 401k. And when you pay it back, of course, the interest goes to you because it's your money you borrowed. And at the time, there was an interest deduction. It was an expense you could write off. How about those cookies? Well, of course, Congress closed the loophole on that one pretty quickly, so you can't do that anymore. But it's still an awesome, awesome deal. Now, what that means is the money that you pull out, you're obviously going to be using it for other purposes. In this case here, you're going to be using it to purchase an income-producing asset, duplex, triplex, fourplex, mixed-use property, whatever it is. Okay, you're going to use it typically for a down payment on that property, and you still have to get I would suggest a community bank mortgage for the remaining 70 or 80%, whatever it is you're putting down on the purchase of the property. The remainder has to be financed. You can buy a property outright with money you borrow from your 401k. There's no reason why you can't do that. But quite frankly, with interest rates the way they are right now, why wouldn't you to use leverage? Just use your money for down payments. Use the bank's money for the remainder of the purchase. Okay, for the balance of the purchase. But in any case, so the couple things to remember here is this: there usually is a nominal fee, like an application fee to fill out to borrow your money. I've seen them be as small as $50 and as much as $250. They typically will give you a time frame that you have to pay that back in. And I'm okay with that. If it's like a year, that's fine. I'll pay it back in a year. Also, those monies that you pulled out, of course, they're not in there earning money like they would have if you left them in your 401k. So obviously you're okay with that because your intention is to invest the money in income producing assets, i.e. real estate, which will far outperform whatever you got in your 401k. But nonetheless, you want to treat it with respect and be a good money manager and be disciplined. Something else to remember is this: if you leave your employment, which you will at some point if you keep doing this, because you'll have enough income coming in from your assets, you'll switch from working for money to having your money work for you. But what I'm getting at is this: is if you leave your company and you have an outstanding balance on your 401k, you better pay that sucker back pretty darn quick. Okay, they're going to tell you that this is all going to be written up for you in documentation. But if you don't, you'll have to pay an IRS penalty on that because it's going to be construed as from the IRS as if you took the money out and outside the guise of borrowing against your 401k. You really can't do that. It's just one unique opportunity within the world of 401ks that you can do this. So just remember that. And by the way, let's say you leave your employment and you left your 401k there, which you can do. Once you leave the employment, you cannot borrow against anything you leave in the 401k. So what we suggest is to roll it over into a self-directed IRA, which I'll discuss next year. But I just want to make sure everyone is clear on borrowing against the 401k to buy a property. So you obviously can do it. Key features allows you to leverage something you've already got, borrow against yourself, acquire another asset, pay the 401k back with interest. It's like completely, totally win-win all the way around, and you're the winner. All right. These are great strategies, by the way. These are strategies that allow us to play with a game plan to win, which is different than playing not to lose. Playing not to lose is not the same as playing to win. Successful people play to win. Okay, I'm not saying be careless or frivolous. That's not what I'm saying. You want to be smart and be disciplined. Okay, but be creative and use what you've got to your greatest advantage. The people that are playing too conservative, playing not to lose, usually in the end end up losing. Okay.
If you're anything like me, listening to good advice is helpful and inspiring at the same time. But having a reference guide at your fingertips is invaluable when I sit down to do serious planning. That's why if you go to the website, myinvestorservices.com, at the very top of the page, actually sort of near the middle, you'll see 5 different guides on 5 different aspects of real estate. All these are free, and all of them can help you impact your bottom line. Just check it out. Go to myinvestorservices.com, right smack in the middle, click on any one you want or all 5 if you want.
So in any case, that's one strategy. I mentioned self-directed IRA, so let's just touch on that for a spell. Let's say you do leave your employment, you can take that 401k and roll it over into a self-directed IRA, right? You can also, by the way, start a Roth account at any time. It's just, matter of fact, I really encourage you to start a Roth IRA at your earliest convenience within the guidelines of that program. So it all depends on your income, which you've already got in retirement, all that kind of stuff. But in most cases, you can set up a Roth IRA. You could even do it with a family member too, like a son or a daughter or a spouse, what have you. Okay. But in any case, with a self-directed IRA, what's interesting about that is you have been able to do this for quite some time now, but about say the last 15 years, for example. You can buy a property inside the self-directed IRA. From inside the self-directed IRA, you can purchase an income-producing asset. You can do a number of things, actually. You can actually take your capital inside the self-directed IRA and lend that out. You can lend it to other investors and earn, just like a mortgage, you can earn interest on that. But in our example, what we're talking about is you buying your own asset inside that IRA. Now, let's say, for example, you're going to flip a house from inside the IRA. So you take a portion of your assets inside the self-directed IRA. You go out and you buy yourself a beautiful 4-bedroom, 2.5 bath, 2-story colonial with a family room on the first floor, eating kitchen, dining room, family room, and a integral garage underneath with the other half of the basement finished off for a game room. And you're going to flip that house. Well, let's say you buy it for $200,000. You put $100,000 into it to remodel everything and fix up the yard and all that stuff, and you sell it for $400,000. In other words, you put 300 into it, 200 on the purchase, 100 on remodeling, and 100,000 you gained on the sale. That was your net. 400,000 minus 300,000, 200 for purchase, 100 for remodeling. So 400 minus 300 leaves you $100,000 of profit. Well, the good news is 100% of that profit goes back into the IRA, self-directed IRA. And at that point, you don't have to pay taxes. You don't have to pay capital gains on that, okay? Because it was all done within the self-directed IRA. Now, when you're 59 and a half years old, or anywhere between 59 and a half and 70 and a half, at some point you do have to start withdrawing from your IRA. So the proceeds you withdraw at that point, that's where you begin to pay taxes. It's whatever your rate is, at whatever your tax rate is at that point that you withdraw from your IRA in retirement, you pay at that rate. So you could have huge gains inside your IRA, and all those gains have been protected all the while from taxes, capital gains and income and otherwise, while it's in the IRA. It's only when you start pulling money out that you have to start paying taxes on that money. So it is a tremendous way to massively grow your retirement funds, okay? That's just an example of a flip. Let's say you buy a rental in there. Yeah, you buy a rental, you put that in the IRA. All the net operating income, which is your rents minus your expenses, stays inside the IRA. Meanwhile, the property you bought, let's say you put a mortgage on it. I should touch on that for a second. When you buy a property inside an IRA and you're using financing to buy the property, you have to get what's typically referred to as a non-recourse loan. What that means is if you default on the loan, the bank has no recourse against the property because the property by federal law is protected inside the self-directed IRA, protected from lawsuit. Okay, so what I'm getting at is generally banks that will do non-recourse loans are not going to loan you up to 80% loan to value. They'll loan you at the most 60, 65%. Some of them will just go to 50% loan to value, which means your cash in your IRA has to pay the other 50%. But the beautiful thing is, let's say you fall upon hard times or somebody gets injured and you can't make your mortgage payments, that property is protected inside the IRA, all right? Okay, so it's an interesting coincidence about that, just a little tidbit. In any case, let's talk about one more thing here. We talked about 401ks, we talked about self-directed IRAs, and there's some great companies that we recommend, by the way, that work with when it comes to self-directed IRAs. Just go to myinvestmentservices.com or shoot us an email, support@myinvestmentservices.com, and we'll connect you with one of those preferred vendors. Sometimes I have them come speak at our 3-day events, and sometimes I'll do things for them too. I'll speak for them or be on one of their webinars. Or I've written articles for them, by the way. So in any case, the third possibility is this. It has to do with a whole life insurance policy. Now, a lot of you might be thinking right now, well, Gary, I just have term life. My term life never has any cash value. I understand that. In my early days, I listened to all of the so-called experts, and they told me, yes, just get a term life insurance policy. The rates will go up every time if you did a 10-year fixed rate term, then in 10 years you got to qualify again, get another policy. At that point, your rates will be higher because you'll be older and so forth and so on. But it never develops cash value. Whereas a whole life policy, whatever you get in at, whatever age you get in at, that's what you're going to be paying at that rate. Number one. Number two is you build up what's called cash value. Now, I understand you generally don't look at life insurance, whole life insurance as an investment vehicle. Now, the sellers of whole life policies will try to convince you that it is. But here's the reality. Generally speaking, the returns aren't enough to keep up with other possible ways to generate returns, which are like investment real estate, for example. However, let me describe this to you from a different perspective. The fact is, a lot of affluent people do have whole life policies for a couple of reasons. Number one is, let's say they own their own business, their own practice, though they know full well if something happens to them, they pass away, that business probably dies. Well, they want their heirs to be protected with a big generous whole life policy that will make up the difference between what the heirs no longer get from the business, because the business is basically going to fall apart with this person no longer there, and keeping up their lifestyle. But it goes deeper than that. You can actually borrow. You can do a couple things with your cash value of your whole life policy. You can take money out of the cash value, but you can't put it back in typically. In some cases, you can borrow against that cash value of the whole life policy. So you can borrow against the cash value, all right, borrow that money out, buy a property, put the money back in some cases. In most cases, though, what you do is you actually get a third-party loan, and you use the cash value of your whole life policy as a guarantee. So here's how this works. And by the way, you don't have to borrow against your own whole life policy. You can actually borrow against someone else's whole life policy. Okay, so let me just describe this. It'll make a lot more sense. There are companies out there that will let you borrow against cash value in your whole life policy without actually touching the cash value in the whole life policy. You just simply borrow against it. It's listed as a pledged asset. In case you default, here's how they get paid. Let's say you're a lender. Let's say you got $100,000 cash value in your whole life policy, and the lender is going to lend you $50,000 based on the fact that you've got $100,000 in cash value. What they're going to have you do, though, is sign a document where they're going to be named an additional payee on any proceeds being paid out from a whole life policy should you meet your demise. So they guarantee themselves that they get paid. They get paid back no matter what. Now, if you pay them back before you pass away, obviously that restriction goes away. Okay. Now, here's what's interesting. Obviously, you can use that to put a down payment on a new property and finance the rest and get yourself another property, and keep reborrowing against the same whole life policy. Every time you get another property, you buy it, you fix it up, you refinance it, pay back what you borrowed, and keep doing it over and over again. But what's interesting is this: you can actually borrow against someone else's whole life policy. Okay, let's say you have a proverbial rich uncle, and you say, "Hey, rich uncle Rich, let's call him Rich. I'm going to be buying a fourplex, and I want to borrow against your whole life policy. I'll do all the legwork. I'll do the borrowing. We're going to pledge your cash value of your whole life policy as collateral for the loan should I default. But here's what I'm willing to do. I'm willing to take out a term life policy on you should you meet your demise while this loan's outstanding for the amount that we borrowed, not the whole policy amount, just the amount that we borrowed. And I'll even sweeten the pot. I'll get a term life policy on me in case something happens to me and I can't pay back the loan where your whole life policy is leveraged. So no matter how you slice it, you win, your uncle wins, and the lender who loaned you money against that, your uncle's whole life policy has guaranteed protection no matter what. No matter who passes away, they're going to get paid. All right. And again, you can use that money to buy an income producing asset. So how do you like them apples? Pretty creative strategy. So there's more creative strategies. I'll do those in another podcast that do have to do with you borrowing against yourself. And I'll explain that when we get to the other podcast. In the meantime, right now, commend you for staying on board here. I know it's a little bit more of a complex subject than we're used to, but I just want to open up your eyes, expand your field of vision, and show you that there are ways you can invest so that you're not stuck at that cube cranking out diagrams and for engineering projects. You're not stuck in the firehouse. You're not stuck in your police cruiser. You're not stuck in the classroom for 35 years. You're not stuck behind the chair in your practice until you're 65 years old. Use these skills, use this knowledge to get yourself out from behind that chair and out from behind that cube and enjoy life because you deserve it. Okay. You can leverage your business to do this. You can leverage your knowledge, your skills as a professional in your industry. You think more clearly than most people. You think more intelligently than most people. So let's take advantage of that and be part of the community. Speaking of the community, again, you can go to myinvestmentservices.com, log in, and you can join up right there. You can also email support@myinvestmentservices.com, and Beverly or Jody will help you get set up there. And also make sure you subscribe to the podcast. If you like this podcast, we'd love to have you on board because we have a lot more coming your way. Obviously, this is on iHeart Music and iTunes, and you can see on your screen there where you can subscribe. So go ahead and do that. Any case, in the meantime, you guys have a wonderful day, a wonderful evening, and start using your imagination for how you can use this to launch other activities, whether they're for pleasure or for business. Use income-producing asset investing, i.e. real estate investing, is not the end game. It's the platform upon which you launch other things that you really desire. Okay, guys, we will see you next time. In the meantime, take care and God bless you and your families, and we'll see you next time. Bye-bye.
Thanks for listening to this episode of Real Estate Investing for Professional Men and Women. Be sure to go to myinvestmentservices.com to join our community and start building wealth today.